Let's take a look at Meta Platform stock today. We'll examine the options market, where I'll show you the 3D volatility. We'll delve into the overall volatility skew, and historical volatility. Let's see what the market forecast is. We'll also analyze the recent report to understand why the stock dropped so sharply. As usual, I'll show you a strategy where you can profit from both price increases and decreases. Let's start from the beginning. Today, the stock fell by 10%. I waited specifically for the market to close to provide you with a detailed overview of today's trading. What happened? The stock was declining from the outset. Let's review the report and the data we have. Here are the details we've got. Total revenue $36.5 billion, up 27% year over year. Net income $12.4 billion. Free cash flow $12.5 billion. Total debt $18.4 billion. If we summarize, the decline was partly due to this. That stoked investor fears that Zuckerberg was plunging Meta into another costly endeavor at a time when its augmented and virtual reality business was losing billions of dollars each quarter. Investors were caught off guard by higher capital expenditure, exacerbated by slightly softer second quarter revenue guide. That's all good in theory, but personally I'd focus more on what the market is indicating and telling us. Firstly, we had very high volatility. Before the report, it reached 130%, indicating potential movements of around 10 to 15%. After the report, volatility decreased. This is a normal situation. On some strikes, volatility dropped to 30%, indicating that the stock has stabilized more. Now let's look at the volatility skew. As we can see, towards the call options, volatility doesn't increase, but towards the put options, volatility does increase. This is logical because investors hedge their positions by buying put options. However, hedging before the report was very expensive because volatility was very high. Let's look at the historical and implied volatility. The current historical volatility is represented by the gray line, and the implied volatility is represented by the white line. Of course, after the reports, implied volatility decreased, but before the reports, both volatilities were roughly at the same levels. I always mention that besides trading the stock itself, you can also trade volatility. I often use such strategies, but you need to use derivatives for that. Let me show you how it can be done. Here we input the volatility. For instance, an increase indicates that the volatility for this stock will rise by 20% by July 2024. As we can see, the AI calculates strategies for us. What can be built? Here's an interesting strategy: buy a put option with a strike price of 145 for July and sell a put option with a strike price of 145 for August. This is how it would look. Here we compare with other strategies, but I'm showing you this solely as an example. For actual trading, I don't recommend using bots, third-party programs, or following bloggers' advice. It's crucial to understand how to trade qualitatively, to fundamentally approach this issue, and to develop your own strategies to earn well. Let's look at the options trading volume. It provides answers to many questions. As we see, the main volumes for call options are concentrated at the $450 and $440 levels. For put options, the main volumes range from $400 to $420. This is a significant sign. In this range, as we see, the price was supposed to stop. So it happened today. As we can see, there was a very large volume at the $400 level, and the stock stopped precisely there. Let me explain to you exactly how this works. We have options, and we have market makers who sell call options. Regular traders, investors, buy call options, while market makers sell call options to avoid losses on those call options. They need to hedge their stocks. They hedge by delta neutral strategy, meaning they buy stocks equal to the delta. This is a dynamic strategy, a basic strategy. The essence is that when a stock starts to rise sharply, as it has been for the past 6 months, the effect of a spiral starts. That is, the higher the price goes, the more the market makers have to hedge, and the more the price rises. And this continues until a large sale is made by some major player. Only then can it be stopped. Before that, prices can be driven very high. And that's what happened here. But when the price stabilizes and starts to fall, naturally, the effect works entirely in the other direction. Let's look at the main volumes for this week on April 26th, which is practically tomorrow. We have options expiring at $450, at $40, at $400 very large volumes. What I can say is, if we close tomorrow, Friday, below these levels, then market makers tomorrow and next week will be obliged to completely sell off all this accumulated volume. I agree with you that some portion of the options will be carried over to the next week and then to the next. But again, money is not limitless, and sooner or later this must end. And what could happen? Regardless of how you feel about this stock, good or bad, the situation may simply arise from a technical aspect where market makers are obliged to sell all their shares, and the stock may start to plummet very rapidly, but as it actually did in 2022. We see a frenzy of sell-offs here, and the stock practically fell every day, lower and lower. And the same thing happened in 2023. The stock constantly rose up and up. Let's see what the market expects. As we can see, the market expects that with a higher probability, we will be at a level of $430 to $450. Here is the highest probability. If we talk about the month, if we talk until August 2024, then the market expects the stock to be at lower levels. That is around $420, $430. So the market is slightly pricing in a decline in this stock. Again, I'm telling you my forecast. I am solely showing you what the market is saying. Then you'll be kind of a know-it-all. You'll be arguing with the market, and that can end very badly. Sometimes you win, but again, in the long run, I wouldn't advise you to argue with the market. Also, I remind you that my philosophy is that I can't predict price movements. I don't know where the stock will go. That's the most important thing. It's about managing positions and portfolios wisely. So what I want to say is if you learn to manage your portfolio and stocks wisely, you'll make money anyway, no matter where the price goes. Let me show you this strategy. But first, let's touch on 3D volatility. I often show this. Here we have all the data concentrated. In all the data on expirations and volatility, it often helps to build good strategies. But let's go straight to the strategy. Here's how it looks. I use option derivatives. As we can see, if the stock continues to rise, we can make $6,000. If the stock falls to $390, we will make $4,000. But I immediately say that this strategy is risky because it involves selling uncovered options. I strongly advise against opening it because these strategies need to be managed. This strategy is not about opening it and holding it. This strategy is solely about managing it, closing an option, opening a new option, buying an option, selling an option, not buying or selling the underlying assets. This strategy needs to be managed, and only then can money be made. I'm showing you solely to see that you can make money on any price movement. That's why I always emphasize it. Also, again, in my opinion, the risk-reward ratio is not in favor of the investor right now. I fully admit that we may rise to $500. Close this gap. It's possible. But again, the risk-reward ratio is not in favor of the investor. That is, the mathematical expectation works against you. It's always risky. So at this moment, yes, you can try to catch this upward movement, but you need to think about the long term. You'll always end up losing. So I wouldn't advise playing against mathematics. Again, some people work with technical analysis using various metrics and indicators. I still prefer working according to math. According to mathematics, I will definitely talk about this in the future. How I build a portrait, how I form positions. If you're interested, write in the comment. Be sure to specify what exactly interests you about the responsible question. So, if you work according to analysis, according to mathematical expectation, you will make money. Actually, the report turned out good. Profit is growing. Everything is good. But expenses are also growing. This is not very good. I also advise you to watch my previous video about Tesla stock. I also analyze strategies there. Direction of price movement. Good luck to everyone.